Wall Street isn't just buying up homes, they're orchestrating the most significant foreclosure crisis ever. They've already set aside $127 billion to capitalize on the fallout. This isn't a typical market cycle, it's a deliberate manipulation of the real estate market, coupled with an aggressive corporate takeover of American housing. Let's examine the current landscape. In the first quarter of 2025, Miami's foreclosure listings have surged from 5% to 18% of total inventory in just 6 months. Phoenix has seen pre-foreclosure notices increase by 32% year over year, and Denver reports more foreclosure starts now than at the peak of the 2010 crisis. But what's truly unprecedented is the involvement of hidden players behind these numbers. A seasoned real estate agent observed, "Every single one of my 47 foreclosure listings received multiple cash offers within hours, all from different LLCs. Upon investigation, they all traced back to 7 major investment firms." This isn't normal market activity, it's a coordinated takeover. Following the money reveals a more troubling story. In the past 12 months, Blackstone has raised $30.4 billion specifically for residential acquisitions. Progress Residential increased their buying power by 312%, and Invitation Homes announced plans to acquire 50,000 single-family homes by 2025. Meanwhile, Pretium Partners allocated $7.2 billion for what they term distressed residential opportunities. The geographical spread of this corporate takeover is alarming. In 2020, there were just 6 red zones, areas where corporate ownership exceeds 30% of single-family homes. Today, there are 47, and projections indicate that 152 metropolitan areas will be under institutional control by 2026. This is just the beginning of an economic shift that will impact millions. So make sure to like, share, and subscribe to Economy Explorer. And don't skip any part of this video. Every detail matters. The Triple Trap: How Wall Street Engineered the Crisis. To understand why this crisis is unfolding now, we need to examine what industry insiders call the Triple Trap, a financial strategy designed to squeeze homeowners into distress while maximizing profits for institutional investors. During the pandemic, millions of homeowners entered mortgage forbearance programs, believing it would provide them with temporary relief. But what seemed like a lifeline quickly turned into a financial time bomb. As missed payments accumulated and interest continued to compound, homeowners found themselves in deeper debt than they had anticipated. At the same time, artificially inflated property values created a false sense of security, masking the long-term consequences of these financial decisions. Now, as the housing market corrects itself, these homeowners are facing an economic reckoning that was inevitable from the start. The numbers that reveal the truth. The housing market is deteriorating faster than most people realize, and the warning signs are everywhere. Across the country, hundreds of thousands of homeowners remain in loss mitigation programs, with a significant portion having gone more than 2 years without making a single payment. Mortgage delinquencies are creeping higher, and as financial institutions tighten lending conditions, homeowners who were already struggling to catch up now find themselves backed into a corner. The numbers are staggering. Accumulated debt from forbearance continues to grow, pushing more homeowners into distress as the window for refinancing closes due to rising interest rates. Meanwhile, median home prices, which had previously surged to record highs during the pandemic-fueled housing boom, are now declining at an accelerating rate. In many regions, the sudden price corrections are erasing the equity that homeowners had relied on as a financial cushion, leaving them with fewer options for selling or refinancing. Those who once believed that home appreciation would protect them from economic hardship are now watching their property values drop, while their mortgage balances remain painfully high. The combination of falling home prices and increasing financial pressure is creating the perfect storm, forcing many homeowners into difficult decisions about whether to sell at a loss or hold on and risk foreclosure. At the same time, rising interest rates and broader market instability are making the situation even worse. The cost of borrowing has skyrocketed, and as affordability declines, demand from traditional homebuyers is evaporating. This shift is placing even more downward pressure on home prices while giving institutional investors an opportunity to expand their dominance. As more distressed properties hit the market, Wall Street firms are standing by, waiting to scoop them up at steep discounts. The safety net that struggling homeowners once relied on, whether it was refinancing, loan modifications, or rising home values, has been ripped away. Now, they're left with mounting debt, limited options, and growing uncertainty about the future of their homes and financial stability. How investment firms are controlling the market. But this crisis isn't just happening, it's being orchestrated with precision. Investment firms are not simply reacting to market conditions, they are actively shaping them to their advantage. Armed with AI-driven predictive models and advanced data analytics, these corporations track homeowners who are at risk of financial trouble with unprecedented accuracy. They monitor mortgage payment histories, tax delinquencies, and even search patterns related to home sales, allowing them to predict who will struggle to keep their home months before those homeowners themselves realize the danger they're in. This is not a passive strategy. By identifying distressed properties early, these firms position themselves ahead of the market, buying homes in bulk before they are even listed for sale. In doing so, they manipulate inventory, restricting supply and driving up home prices artificially, while simultaneously ensuring that individual buyers, who often rely on traditional mortgage approvals, are priced out of competition. These corporations don't simply buy homes, they systematically control the housing pipeline, determining which properties are available to the public and which are reserved for institutional portfolios. With their immense financial power, these firms can outbid individual buyers with all-cash offers, securing properties faster and often below market value. But it doesn't stop there. By strategically purchasing clusters of properties in the same neighborhoods, they create localized housing monopolies, allowing them to dictate rental prices and long-term market trends. Homeowners, first-time buyers, and even small-scale real estate investors are left with limited opportunities as Wall Street's control over the market tightens with each transaction. This isn't just a natural market cycle, it's a carefully engineered financial maneuver designed to consolidate wealth, expand corporate dominance over housing, and shift home ownership further away from individuals. The goal is clear. Turn America from a nation of homeowners into a nation of renters, with large financial institutions acting as permanent landlords. And unless something changes, that future is already unfolding before our eyes. The hidden shell companies controlling real estate. If you've ever wondered why so many properties are being bought up in your area by anonymous cash buyers, the answer lies in corporate shell networks. These large-scale institutional investors are operating behind a maze of LLCs, making it nearly impossible to track the true owners of these properties. A single investment firm can create dozens of different LLCs, each appearing as independent buyers, when in reality, they are all controlled by the same corporate entity. This strategy allows them to place multiple bids on a single home, driving up competition and shutting out regular home buyers. It also helps them evade regulatory scrutiny, manipulate local market data, and maintain a level of secrecy that prevents the public from understanding just how much of the housing market they actually control. The disastrous impact on local communities. The growing dominance of corporate homeownership is having devastating consequences for local communities. In neighborhoods where institutional investors own more than 30% of single-family homes, the effects are impossible to ignore. Over the past year alone, rent prices in these areas have skyrocketed, outpacing wage growth and pushing more people into financial hardship. Families that once planned to purchase homes are now forced into a permanent cycle of renting, unable to afford the inflated prices set by corporate landlords. Homeownership, once a cornerstone of economic stability and wealth building for the middle class, is rapidly becoming an unattainable dream. Instead of investing in homeownership, people are being funneled into rental agreements where they pay higher costs for less stability, all while corporate landlords reap record profits. The next 3 waves of the crisis. But this housing crisis isn't happening all at once. It's unfolding in 3 distinct waves, each making the situation progressively worse. The first wave is already underway. Homeowners who entered mortgage forbearance early in the pandemic are now facing the reality of accumulated debt and rising interest rates. Many are discovering they can no longer afford their payments, forcing them to sell under distress or enter foreclosure. The second wave, which will accelerate in mid-2025, is what financial insiders call the HELOC tsunami. Homeowners who took out home equity lines of credit, HELOCs, when interest rates were low are now facing massive payment resets. As these loans adjust, monthly payments will double or even triple overnight, leading to another surge in distressed property sales and foreclosures. The third and final wave is the perfect storm, a collapse that ties residential real estate to the broader economy. The commercial real estate sector is sitting on a $1.2 trillion debt bubble that is already beginning to burst. This collapse will send shockwaves through regional banks, making it even harder for the average homebuyer to secure a mortgage. As traditional financing becomes more difficult to obtain, institutional investors will swoop in to dominate the market even further, tightening their grip on homeownership and shifting the U.S. housing economy into a permanent rent-based system. The final takeover: what this means for you. The next 18 months will determine the future of homeownership in America. The transition from a market built on individual homeownership to one dominated by corporate landlords is happening right now. While most people remain unaware of the true scale of this takeover, institutional investors are already executing their final strategy, one that ensures they maintain control over housing while everyday people struggle to keep up. If trends continue unchecked, we are looking at an economic landscape where the majority of homes in high-demand markets are owned not by families, but by billion-dollar firms that control rents, home prices, and the future of housing itself. If you want to stay ahead of these massive shifts and protect your financial future, now is the time to take action. Make sure to like, share, and subscribe to Economy Explorer. And don't skip any part of this video, because every single detail matters. This information is what Wall Street doesn't want you to know. So help spread the word by engaging with this content. And if you want to understand how these housing market shifts will impact the economy even further, watch this next video, linked here.